webcast is now starting. All attendees are in listen-only mode.
Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from our 2017 webinar survey. So watch for a question you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, 1 for each month. And who knows, maybe one lucky viewer will be able to have a chance to win a 20th anniversary gift from LLIS. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA, and has been writing the LLIS story as president and CEO since 2013. And now, Mark Maurer.
Thank you, Claudia. And what I was going to start off the webinar with was all the things that I did when I was in my 20s, but then I decided that maybe that wasn't a good idea. So the fact that any of you all have clients in their 20s, or you're in your 20s and you're already in this profession, kudos to you. So you've already, doing well for yourselves, and you have clients who are coming to you early and wanting to set up their financial lives early. And I think that's really just a fantastic thing. So for you who are in your 20s, for clients who are in their 20s, what are things that you can help with? And what are some things that we're going to talk about today, just to see what kind of things we can come up with to help them out. Why is it important to start when you're in your 20s? Well, the first thing, and this probably, I imagine everybody can figure this one out, is that you're never going to be younger. And that's just true. As costs of insurance costs increase as we get older. Life insurance, disability insurance, long-term care insurance, most things, health insurance. As we get older, the premiums tend to increase. And so the time to look into many types of life insurance or disability insurance are when you're young. Why? Because we're never going to get any younger. Still, unless we have a Superman who can fly around the earth and spin the earth backwards and we actually get younger, this is one thing that we haven't figured out how to do, is actually lower our ages. Now, some people can actually get healthier over time, but I would say in my late 20s, I probably weighed the most closely to the right amount that I have in a long time, and probably exercised a little bit more than I do today. And so, late 20s, you're probably never healthier. And that comes with our just normal habits, our day-to-day things, but also statistics on things like heart attacks. Average age that men are going to have their first heart attack is age 65. But anywhere from 4 to 10% of heart attacks happen to people before they get to age 45, which still amazes me. But if you think about it, you may know somebody who has had a heart attack at a younger age. So you're likely never to get healthier, and so getting insurance when you're young, before any of these things happen, is going to help. 53% of all cancers occurred in people between ages 50 and 74. It's over half. So when you are younger, you're also probably never healthier. You're able to become underwritten at better rates. So it just helps to start when you're in your 20s if you can. Something we may not think about is that our parents are not going to get healthier in general. Young clients have younger parents. Younger parents are less likely to have had the heart attacks, the cancer, the strokes, the things that as we get older we tend to have happen. Well, the younger you are, the younger your parents are. The younger your clients are, the younger your clients' parents are. So it's less likely that their parents have had any of these heart attacks, cancer, strokes. And it actually does make a difference in the underwriting process. Let's take a look here at Tom. He's age 27, lives in Florida. Everything's going along well for him, and he meets with his fee-only financial advisor, and advisor says, Tom, you know what, time to start looking at life insurance. He says, oh, I'm not old enough for life insurance. Yes, you are. You've got family, got a good job. It's time to start talking about life insurance. So let's look at $1 million 30-year term policy. Tom's in great health. Can qualify for the super preferred or preferred plus rate with pretty much any company out there. And so the lowest premium option out there is $634 a year for a $1 million 30-year term policy. But what does Tom do? He doesn't listen to your advice. He waits. He's going to wait a whole year. And in that year, his father dies of a heart attack at age 58. Insurance companies look at early either disease or death of heart attack and cancer, usually the two big ones. Some companies look at stroke. One or two look at a history of diabetes. But heart attack and cancer are the big ones. Cancer, some companies, depending on if it's gender-specific cancers, don't worry about it. You can even have somebody die of cancer and still qualify for the best rates depending on the type of cancers. But with heart disease, it's sort of it's the big deal. So Tom, now he's age 28, goes to look back for that $1 million 30-year term policy. Best case scenario is that 3 companies out of all the ones that we work with, and I'm guessing 15 or 20 for term, best case scenario is that 3 of them will offer their preferred rate. So not the super preferred rate. Only 3 of them will consider for the second best rate, and that $1 million 30-year term policy 1 year later, $895. Yes, he's a year older, but underwriting a 27 or 28-year-old makes a very small difference in the premium. It will increase a little bit, but I'm guessing less than $20 of that is based on his age. The big part is the change in family history that impacts Tom. He may be in great health, but that family history is so linked that makes a difference in his underwriting. So let's talk about life insurance. Who needs it? Clients in your 20s may or may not actually need it. Here's Mike. He's age 28. He's got his new career, got a nice suit, got his desk stuff, a computer there. But at this stage in life, it's just Mike. Does he really need life insurance? I'd argue not. He's single. Nobody's relying on him for income replacement. He has no dependents, no spouse. If something happened to Mike, he might want to leave his parents something, but there's not really a need because there's no financial loss for Mike, age 28, at this stage in life. But all of a sudden, Mike falls in love. Now, all of a sudden, there's a baby on the way. Now, there's a lot riding on Mike. Now, Mike has dependents, has a spouse, and all of their financial plans are going to be based on him earning his income for the next 20, 30 years, maybe even longer. So what we need to do now is protect his family against the catastrophic loss of his future income. And by using term life insurance, we do it for as low a cost as possible. When you're in your 20s, early 30s, a lot of insurance companies will consider up to 30 times income for income replacement. So this isn't a hard and fast rule. This is just if somebody applies for 50 times income, the underwriter may ask why that seems a little excessive, or give me some details on why this makes sense. But as a just general rule, clients in their late 30s, if they make $100,000, can apply for up to $3 million, really no questions asked. But you work with Mike and realize that he needs about a $2 million life insurance policy. And talk to us, we think that Mike will qualify for the preferred health rate, not the super preferred, but a preferred health rate. And looking at how many years of income ahead of him, 30-year term, and for that $2 million preferred non-smoker rate for a 30-year term policy, his annual premium will be $1,615 a year. So we say, all right, that's not bad. That's a great way to start looking at this. But is there another way to look at it? And since I asked the question, the answer is yes. So let's look at layering policies. Because over the course of the next 20 or 30 years of Mike's working years, he's also going to have some life events. And these are, big picture life events that I'm talking about here. But in 20 years, we're expecting that Mike's kids are going to be out of the house. They're little today, but over the course of time, they get older, they learn to drive. At some point, they're going to be out of the house, we assume. So, we hope. In 25 years, while Mike's working, he's hoping that in the next 25 years, after the kids got out of the house and they're through college, you know what? By then, I've been saving for college for the last 25 years, and if there's anything else I needed to pay for, I've got it taken care of. So in 25 years, I don't need any income replacement to pay for college anymore. And so the next 30 years, I'm planning on working. And so my income, or Mike's income today, is going to fund all of these different things. But at points in time when that need's no longer there, can we reduce the coverage because he already has years behind him? In 20 years, if Mike's alive, he has 20 years of income behind him, so he doesn't have as many years ahead of him. So we take that $2 million policy over the next 30 years, it's $1,615. But that means that the week before Mike retires in 29 and a half years, if he died, he's still worth $2 million, even though his income might be $50,000 or $60,000. So is there a way to layer this and customize this to Mike? Sure. So we'll take $1 million 20-year term policy. So of the $2 million, half of it is this period of time when the kids are small. To me, that's the biggest period of time when you need the life insurance, when there's small ones depending on you. $500,000 of 25-year term for college, and the last $500,000 30-year term to finish up any lost retirement savings. Because, as parents, we think about ourselves last. The first thing we want to worry about is our kids. So by taking those policies, Mike still has $2 million in life insurance for the first 20 years. But then by doing that, the sum of all these three policies is $1,385. That's 14% less per year for the same $2 million for the next 20 years. And then in 20 years, that 20-year term policy drops off. It reduces down to $1 million after that, and the premium for $525,000 comes off. I have a question. Why not just a decreasing term policy? Most companies don't offer a decreasing term policy anymore, and the ones that I have seen have a level premium for all those years, even though the life insurance is reducing. So here we actually have both, reducing life insurance and reducing premiums. So good question. Decreasing term is sort of one of those things that it makes sense conceptually, but insurance companies just haven't quite figured out how to price them well. So here's a great way to do it instead. Now here's Kurt, age 27, and he's soon to be a father. He's not a baby. He's going to have a baby. So he's a soon to be father, and he meets with his financial planner, and you meet with him and you say, Kurt, you actually have a good amount of life insurance through work, but we'd like to supplement that coverage. $500,000 of 20-year term policy. And Kurt is another preferred non-smoker. He also takes care of himself. But he remembers that he has this baby life insurance policy. What exactly does that mean? Well, Kurt's parents meant well. And so we see these regularly for clients. Clients' parents purchase these policies, may have been from Alex Trebek or something that they got in the mail. $5,000, $10,000 policy. and you take it out when you have a baby, and you pay $50 a year or $25 a month for these little policies. And what happens over time is that, like almost all bills, we just pay them and pay them and pay them. And at some point, Kurt's parents ended up with a $10,000 death benefit whole life policy. They've paid in $3,000 over the course of time. It actually has a $4,000 cash value. So there's a $1,000 gain in this policy. And so what we'd look at first is making sure who's the owner. Well, Kurt's parent had already transferred the policy to him. So Kurt is now the owner. So we looked at this and said, well, there's a $4,000 cash value, but they paid in $3,000. So there's a $1,000 gain that if Kurt were just to cash it in and do something else with it, he's going to have a $1,000 1099 owe tax on that this year. So the first question from the fee-only financial advisor was, knowing that this is life insurance and there's some money here that we maybe could use towards a different life insurance policy, how do we avoid the gain? Well, we use a section of the Internal Revenue Code. The section is actually 1035, so we do what's called a 1035 exchange, which allows you to transfer cash value from one life insurance policy to another without creating any taxable event. So it's like an IRA transfer, IRA rollover from one holding company to another. So what did we look at? We took the $4,000 and did a 1035 exchange to a term UL policy with a 20-year guarantee. So this is actually a universal life policy, but it has a guaranteed premium and a guaranteed death benefit for 10, 15, 20, 25, or 30 years. It looks like, smells like, tastes like a term policy. Guaranteed death benefit, guaranteed premiums, guaranteed period of time. But it's on a universal life chassis, which is a flexible premium type design. So what we were able to do is take the $4,000 into this policy, avoid the gain altogether, and he's just going to pay $8.91 per month in additional premiums. So the $4,000 wasn't quite enough to guarantee the $500,000 for every year or for all 20 years. But what we could do is get Kurt the use of all $4,000. If he surrendered, he'd have to pay tax on some of that. So he wouldn't actually get to use all $4,000. By doing the 1035, all $4,000 of that is going into this policy and being used, and he just needs to pay an additional $8.91 per month to keep that full $500,000 of 20-year coverage going. So the question is, what is the amount of the 20-year term UL? $500,000. So in this case, that was with a gain. We want to avoid gains anywhere we can. What if there's little to no gain? Maybe a small gain, small loss. Let's say the cash value's that same $4,000 and they've paid in about $4,000 in premiums. We could do the same thing, do the 1035 exchange to the term UL policy, or just get traditional term insurance and then surrender this policy. So by having a small gain or loss, we have little to no taxable event. So what's the better option here? Well, if we take the term UL policy, the $4,000, Kurt's going to pay the additional $8.91 in monthly premiums. So over the course of the 20 years, there's the $4,000 that went in, plus the additional $8.91 per month for 20 years. Sum of total premiums, $6,138. So that's what I'm comparing, how I'm going to compare each other. What's the total amount of premiums that went in? If Kurt then just purchased a $500,000 20-year term policy, he'd pay $26 to $27 in monthly premiums. So the sum of premiums is $6,240. About $100 more, almost right at $100 more over the course of 20 years for the traditional term policy. However, he would have received $4,000 in cash today or at the start of all this. So which one's better? Just depends. You could probably argue that by having the $4,000 today and doing something else with that, saving, investing, paying off mortgage, it's better and paying an additional, over 20 years, an extra $100 in total, if you can surrender the policy and have little or no taxable event. But if you have a spendthrift client, somebody who you say, if they get that $4,000, it's not going to go to the mortgage, it's not going to go into their 401k, it's going to go who knows where, then the term UL policy may win the day because you're freeing up some cash flow, and there's the cash values in the policy are going towards the term UL rather than being completely available for them to spend. If the policy's in a loss position, they've paid in $3,000, they have the cash value of $1,500. Again, if it's in a loss, we know there's no taxable event. My preference is just to get the term coverage they need and then surrender the policy. In this case, for $1,500, I think they can buy 1.5 iPhone X's. When we know that there's no gain and even a fairly substantial loss position, to me, I think the traditional term policy and then surrendering the other one makes more sense, just from a mechanics, not having to go through the 1035 exchange process and some of those things, if there's no real tax benefit to do it one way or the other, or if the clients are just going to blow the money, if they surrender it, then the term UL may be a good plan. I seem to get more questions about this every time I talk about it, so I'm going to talk about it again just because I get lots of good questions and everybody seems interested. So marijuana use. Again, the younger the client, the more likely, and this is anecdotal, but more likely they are to use marijuana in some form or stage. Actually, it's probably not anecdotal. I could probably back that up with real numbers. But younger clients are going to more likely to use marijuana than older clients. And partly because there's also all these different versions. There's edible gummy bears and things that it's become legalized in more states. And for younger clients, it's been something that has always been legal, or for some of their adulthood. So it's not as big of a deal. In the past, and for a long time, insurance companies, when people have their exams and have the blood and urine samples, insurance companies have tested for cocaine. It's funny that they always seem to test for cocaine. I have yet to have somebody who says, yes, I do it, or have somebody who got dinged by it. Just doesn't seem like that's the thing anymore. I think it was in the 80s, not really anymore. But some companies have started running regular panels to test for THC, for marijuana use. But they don't announce it. And so they're starting to introduce this, but they're not making a big deal about it. Why? Well, as soon as somebody says, hey, we've started testing for marijuana, anybody who may use marijuana is probably not going to apply for that company. They'll apply somewhere else and say, we may or may not mention it, but we're not going to use them. So this is something I think that's going to come more and more, and it will just be part of the normal things that insurance companies are running, like cholesterol. It's just going to be, or nicotine, just something that they're going to throw in there normally. And here's why this is important. So here's Ryan, and I was going to write a haiku about this. I wrote a little bit of a poem, so I'll go through the poem, but the poem needs a little explanation. We applied. Ryan was recommended to us by his fee-only financial advisor, so we applied for life insurance, term life insurance. They spied. The insurance company did their reviews, and what insurance companies do, they'll take a look at the application, they'll run a client through his or her information through a medical prescription database, motor vehicle records, And they're also going to take a look at clients' their medical records, and also a review of the blood and urine samples that they take. He denied. On his application, he said no, he's never used marijuana. He was poorly advised. We learn that he says he has a quote-unquote friend who does insurance, and his quote-unquote friend said, don't admit to marijuana use. Just say no, because if you say yes, they'll decline you, which is not true. But if you say yes, they'll decline you. He denied. He was poorly advised. They denied. The insurance company said, we're not offering coverage right now. Why? He said no to marijuana use. Guess what was in his system? THC, which tests positive for marijuana use. We applied, they spied, he denied, he was poorly advised. They denied, he complied. And so we've gone back to the insurance company with the drug questionnaire and explaining this. He uses marijuana gummies about once a month. And so now we're going back to the insurance company and saying, here's what it is. We're telling them, we're explaining that his friend said not to admit it. He realizes now that was a bad idea. So we're still in underwriting now to see if the insurance company is going to comply and make him an offer. So it's important to fully disclose everything. Now, number 10, we've talked about life insurance, but for your clients who are in their 20s, the chances of them becoming disabled during their working years are 4 to 1 compared to dying in their working years. So you're 4 times more likely when you're under 30 to be disabled for a period of time while working than you are to die. So this is why the second half of the webinar, we're going to talk about disability, because this may be as important, if not more important, than life insurance. Here's another thing. Remember Mike, when he was young and single, if he died, there was no loss. What if Mike, who was young and single, became disabled? He's still alive. He has no income, but he needs to be able to pay for medical bills. He needs to be able to keep an apartment. Mom and dad may have to take care of him. So disability is more likely, and I'd argue more important, especially for single people. Single people don't necessarily need the life insurance, no particular loss, but disability, much more important. Like with life insurance, premiums are lower when we're younger. It's just true. So here's Thomas, and I put this together because it sort of makes a double impact here. So Thomas, we looked at a $5,000 a month benefit policy that would pay benefits to his age 65 if he became disabled. So at age 27, and you can see that the coverage amounts are different. When we talk about life insurance, it's $1 million, whether we die today or in 20 years. With disability insurance, we usually talk about 2 age 65 benefits. So at age 27, there's a potential for $2.2 million of benefits between age 27 and 65 for Thomas. And if he starts the policy at age 27, his annual premium is $1,367. Let's fast forward 5 years. At age 32, the total amount of coverage decreases. Why? He's older, but age 65 is still age 65. And the premium increases. So the premium increases because he's older, and the total amount of benefit that he has is actually smaller. So like I said, it's almost like a double whammy. Fast forward between age 27 and 47, 20 years. Instead of 2.2 million, it's 1.1, half as much benefit. And the premium, more than double. So the potential benefit is much higher when we're younger, and the annual premium is always going to be smaller. If we take the sum of premiums, Because I know that a lot of times that's how we want to validate it. Well, I paid premiums for a lot longer. He paid the $1367 for quite a few more years than at age 47 if he started. That's right. But over the course of time, if he'd started at age 27, he would have paid $51,967 in total premiums. If he'd started at age 47, by the time he got to age 65, he'd have paid in $55,000. So the premiums start off smaller, and even though you're paying for it for more years, you actually pay less in total premiums by starting younger. Oops. Here's Phoebe. Same thing. 27, 32, 37, 47. Coverage amounts decreases. Her premiums increase. So as we get older, the premiums increase, the total amount of coverage decreases. What's that difference over there? That's how much higher female rates are than male rates. So Thomas and Phoebe have the same job, same income, same $5,000 a month to age 65, exact same policy. The only difference is male or female rates. Why I like this slide, as you can see, 27, 30, 32, 37, 80, 70% difference. Age 47, well, if Phoebe starts at age 47 and Thomas started at age 47, there's only a 30% difference. Why? What happens? 27, 32, 37, still in childbearing years. So a big part of claims difference in genders is that. And so female rates in the younger years are going to be higher than men. Later on, well, the rates get closer because it's less likely to have kids at age 47. Yes, unless you're Picasso. Number 12, our health usually isn't better. Now, I'm not going to talk about heart attacks because if you have disability coverage, you have a massive heart attack and die. That's a big deal for life insurance. It's not for disability insurance because you weren't ever disabled. There's not really any claim there. What's disability concerned with? Morbidity, not mortality. So things like stroke. Stroke. I'm alive, I'm not able to function, or not able to function as well as I was. I'm alive but not able to work. That's a big concern for disability companies. Overall rates of stroke are decreasing. However, it's increased for young and middle-aged people. The average ages in the mid-90s were 71, and in 2005, it's come down 2 years to age 69. But for people under age 55, 93, 94, 13% of stroke victims were under age 55. In 2005, it had gone up from 13% to 19%, so almost 1 in 5. So that's a concern. But the younger you are, the less likely you are to have this sort of issue. But if you do have this issue, the younger you are and healthier you are, you can have the future increase options included on your disability policy. So the FIO options protect against any changes in health. It's included on your disability policy when you're young and healthy, and it allows you this guaranteed ability to purchase additional disability benefits in the future. You have to justify it financially. You can't just say, well, I'm not making any more money, but I want more disability benefits. You have to apply, get approved financially based on your higher income, but there's no medical questions, no medical underwriting, purely financial. So you could have had a stroke 2 years ago, but if you happen to be making more money, you can still exercise this benefit and continue this policy. So it's a really neat option that protects against changes in health down the line and still allows your clients to protect their income with their disability policy. And there's 2 basic types of the future increase option. I just want to spend just a little bit of time going over those 2. The first one, I'll call it generically future increase options. And these are a stated dollar amount. So usually a policy may have $5,000 of monthly benefits and a $3,000 future increase option, future increase benefit. It's an aggregate number, that $3,000, and you pay a premium to have it on your policy. And so because you pay for it, you get a little flexibility. You can pick and choose how much you want to exercise and when you want to do it. And so I say when to purchase. Every year you're given the option. And so I have your client has a $5,000 monthly benefit with a $3,000 FIO. This year they say, I'm making a little more money. Go through the application, and the insurance company says, based on your higher income level, you can purchase an additional $500 a month. If you do that and you become disabled, then you'll receive $5,500 a month, and your future increase option will be reduced to $2,500 per month. So it's not $3,000 multiple times, it's a $3,000 aggregate. So if I use $500 of that this year, next year I have $2,500 left. And a lot of companies have limitations of how much you can do after certain ages. It's usually somewhere in your 40s, mid 40s, where the insurance companies say, if you have $3,000 a month, we'll let you exercise an additional, maybe a third of it every year after age 45. Why? Well, they're looking at adverse exercises. Let's fast forward or use an extreme example. Somebody has $5,000 in monthly benefit and $10,000 of future increase options. They never exercise. Age 52, get diagnosed with cancer and can't work. Okay, this year I want to exercise all 10,000. At younger ages, you could, but at older ages, when you're more likely to become disabled, they want you to take smaller increments just to protect against that sort of scenario. The other type of future increase option has no stated dollar amount. It's really just whatever somebody qualifies for. One company calls this their benefit update rider. There's no premium cost for this rider, so that's a nice feature. And there's no stated amount. If I had $3,000 of FIO and was eligible for $6,000 based on my really big income run up, I'd be limited to $5,000 or $3,000 with the option before. In this case, it's based on my total income. It doesn't cost anything, so that's good. Sort of if you give in one side, you have to take away on the other. You have to apply. It's offered every 3 years, and you have to apply. And you have to apply even if you're not eligible. Because again, the insurance company here is worried about those adverse exercises. If I had $1,000 a month for 20 years, had a heart attack, and I wanted to exercise and purchase another $15,000 only now that I'm sick, that's an adverse exercise, and so it's a way to protect themselves against that. So you have to apply every 3 years, even if you're not eligible. And part of that is just checking to make sure that you're not eligible. So every 3 years, you send in the information, and the insurance company may say, you're not eligible for anymore, but you get to keep the rider on the policy. So that's good. Let's say you are eligible, your income has gone up, and you are eligible for an increase. Most companies say you must accept something. Remember, you're not paying for it, so it's just a nice benefit to have. But to prevent against those adverse exercises, a lot of companies say you have to accept 50% of what you're eligible for. You don't have to accept all of it, but you have to accept some, in many cases half. And that's fine. But if you never apply, even if you think, I'm not making any more money than I was, even if the client thinks, I'm not making any more money than I was 3 years ago, I'm not eligible. You still have to apply and let the insurance company tell you you're not eligible. Because if you don't apply, they're looking at that adverse exercise issue, and then the rider comes off the policy. So it's important to apply to keep it going, even if your client's not eligible for anymore. And it's a no-cost rider, so that's great. There's a little bit of something you have to do every 3 years, but it's a great benefit to have there. We're talking about our 20-year-olds, so let's talk about young professionals. With disability coverage, insurance companies have in the last few years looked at specific occupations, people who generally have graduate degrees, a lot of schooling, specific occupation and occupational tracks that they're able to offer disability coverage to clients sort of regardless of their current earned income, because they recognize that a lot of people in these programs, their future income and future income potential is much higher than what they start off making. So let's take a look at a pharmacist. This particular insurance company's guidelines say, regardless of what a pharmacist is making, as a first-year pharmacist, regardless of income, any group benefits they have, will offer $3,500 of monthly disability benefits, because the track record of a pharmacist and their potential income and stability is good. So a first-year pharmacist, we're willing to offer $3,500 a month of disability benefits without having to look at any financial documentation. As a resident, $2,500 a month. As a student in their final year, $1,500 a month. Now, I don't know about you all, but when I was a student, I didn't have a lot of earned income. So that's pretty amazing that an insurance company will say, because they're a student, even though they don't have any income right now, based on what they're going to do, we're offering disability coverage for the potential and their future income likelihood. Plus, for the clients under their 20s, this works because as long as they're under 40, some of these programs have no lab work, no paramed exam, no inspection reports, and like before, no financial documents. It's really, if you fall into first-year pharmacist, you can get $3,500 a month. There's an application, and so people can still be declined and things like that, but they try to really streamline it because these people tend to be very young. Well, they're under 40. I think under 40 is very young. They're young. How do we, and we have these set amounts. Let's make it as streamlined as possible. So here we have Cat Feline. She's a first-year veterinarian, small animals. Why I put that? It makes a big difference for disability insurance if you're a small animal vet or a large animal vet. If this little kitty cat decides to kick Cat, it's not really going to matter to Cat. If Cat's working on horses and a horse decides to kick Cat, kick Cat, I didn't even plan that. I like that. Kick Cat, then, that's a much bigger deal if a horse kicks her. So small animal vets, much more favorable to disability underwriting than large animal vets. So for her, being a first-year veterinarian, using the new professionals program, she's eligible to receive $3,000 of monthly benefits without looking through her actual earnings, without looking at any group benefits she may have through the practice, $3,000 a month. And with that, she can include the future increase options, in this case, double the amount she has. So over time, she can increase her disability benefits from $3,000 a month all the way to $9,000 a month. The residual rider, in case she becomes partially disabled, the COLA rider that would increase her benefits if she's been on claim for a year or longer and keeps increasing them for as long as she's on claim, and the $3,000 catastrophic rider that in worst case scenarios would pay her an additional $3,000 per month. Overall, annual premium, $1,700 a year. So it's $1,700 a year, $3,000 of disability benefits now with those options, but additionally, the ability to increase it by another $6,000 per month over time. But now, how did she get to be a veterinarian? She took out student loans, and I keep seeing things that this is a problem and sort of a overall big concern for people as they're coming out of college, as they're starting their new careers, that 70% of graduates leave college with some form of student loan. There's 44 million Americans with 1.4 trillion, yes, that's with a trillion in student loans. 17 million student loan borrowers under the age of 30, and those under 30-year-olds have $376 billion in loans. And the average monthly payment is $351 per month for those in their 20s. And Kat, going to make $71,000 in average to start, but the average debt of veterinarians coming out of school was $174,000. Over 7% had over 300,000. So I'm guessing those are the ones who had to do veterinarian school twice or 3 times. But average debt, 174,000. It's going to take a while starting off making 71,000 to get that $174,000 paid off. And Kat's student loan payment is $395 a month. So we look at her policy, exactly the same as before, but we add a $400 a month student loan payment benefit that will pay her student loan up to $400 per month for 15 years. It adds $62 a year to add that rider. So her premium is still $1,700 and something, $62 a year to cover that student loan payment benefit. I think that's pretty neat. So can disability coverage be too small? I don't think so. Well, it can be 0, and 0 then I think is too small. But can having a disability policy be too small? I really don't think so. Because the major cause of mortgage loan foreclosures is disablement of the mortgagee. People lose their houses because they can't work. 48% of foreclosures are due to disability compared to only 3% due to death. Life insurance would help those 3%. Disability insurance would have helped almost half. 1 out of 18 mortgages not paid are due to the disability of the mortgage holder. So having a disability policy that, if nothing else, covers a mortgage, $2,000 a month, $1,500 a month, protects clients from losing their homes. Not really going to call this bankruptcy insurance. That's hard to say 5 times fast. But 50% of the million Americans who filed for bankruptcy protection in 1999 did so after being sidelined by an unexpected injury or illness. What does that mean? 500 million Americans filed for bankruptcy because they got too sick or too hurt to work. A disability policy would have helped them. And at the end of the day, sometimes less is more, because something is better than nothing. With disability insurance, I really believe that. Life insurance, I really believe that. Kat says, I don't have $1,700 a year. And you work with Kat, and you say, Kat, can we do $100 a month? She said, I can do the $100 a month. She's single, she doesn't need life insurance yet. She says, I can do $100 a month. So let's redesign it. Let's take off the COLA, the CAT, the student loan rider. Let's get her the $2,500 of monthly benefits in case she became disabled to pay her bills. $5,000 of future increase because she's going to make more money soon, we really hope. And it may be, fairly soon, and it may be fairly substantial increases. Keep that residual rider on there. Take off some of the riders, reduce the benefit a little bit. We get her to $100 a month. What is that going to do? That's going to keep her from losing her apartment or losing her house. Is it going to pay for everything conceivable that she might lose? Is it going to pay her student loan debt? No. It's going to keep her from losing her house for $100 a month. I think that's pretty amazing. Get disability insurance while you're working. We have advisors and clients come to us regularly who say, my client's thinking about leaving their job, probably should get some disability insurance now, or sometimes my client is leaving their job, or this Friday is their last day, they need some disability insurance. It's hard to get disability insurance when you have no track record in a new occupation. What income are you going to make? So it's easier to get while working when somebody has a known income and occupation. Get a supplemental disability policy that has those future increase options And then when they move to the new employer, start their own business, they have something that they have that policy already in place, and then can use those increase options to increase the policy later. So what if somebody's newly self-employed but in the same industry? Luckily, we have a little more, insurance companies a little more generous here when you're going from an employer to self-employed, but you're in the same industry. Why? There's reasonable expectations of stability if I'm a CPA working for a large firm and I go to be a CPA on my own. I should reasonably expect that I might make about the same amount of money. It may take me a little while, but otherwise I probably wouldn't have moved. And it's not something new or different I'm doing. It's kind of the same thing. So most insurance companies will offer benefits based on 75% of previous income. Not too bad. But what if you're newly self-employed in a new industry? I did have an advisor one time who said, my client is a corporate exec and his life goal is to become a hot dog vendor. He's going to buy the hot dog cart and work outside of the ball field because he loves going to the ball field and he loves the hot dogs. So that's his goal. That's what he's been saving up to do. There's not really any knowledge of how well an HR executive is going to do selling hot dogs. Does he know to keep the cart clean? Does he know where to buy the hot dogs? I don't even know all the things to ask, but there's little to no expectation or reasonableness of how well he's going to do as a hot dog vendor. Hot dog vendor being a hard one because it's very manual. It's a pretty tricky job to get disability coverage anyway. Is there any stability in it? Probably need 1 to 2 years of documented financials when you start into a new practice or any kind of new industry. And the last thing I'm going to touch on is asset protection. So a lot of your younger clients, and especially those of you all who are working with Henrys, which is something I saw here recently, I loved it. Henrys, high earners, not rich yet. Henrys. I like that. But they have they're in with other high-income professionals who are going to have people who want to sell them insurance. Physicians are probably the number one scenario. And life insurance has some favorable benefits. It offers creditor protection. The cash values are creditor protected in many states. It offers tax deferral on the earnings and growth in the policies. They offer tax-favored income and distributions later on. But the important thing is, are there any life insurance needs? Unfortunately, I see a number of young physicians who don't have a spouse, who don't have anybody, no kids, and they're putting $1,000 a month into whole life policies. There is a cost for this. So only if somebody has a life insurance need, to me, does it even make sense. But all of these things are true. So let's take a look here at Lisa, who's age 29 in Georgia. She's a new OBGYN. Here in Florida, there's a lot of doctors who are just GYNs. The part of being the OB, the malpractice and some of that has gotten so onerous that a lot of doctors are not able or wanting to continue in that. So creditor protection is really a big thing. But she's 29, she's getting a great start in life, has heard from her friends about whole life, how it accumulates money on a tax-free basis and it's creditor protected. Both of which things are true. But with traditional whole life, you're going to have high commissions and it's going to have low early cash values if needs change. So it may take about 10 years before Lisa has a cash value equal to what she's paid in premiums. It may take a decade. That's not a great rate of return. It's also not flexible. Whole life is a fixed premium, so every year whatever premium is specified has to be paid. And in the early years, there's no benefit of dividends or be able to take loans against cash values when you don't have much cash values to add any flexibility. So an alternative, I think a better one, is a low-load universal life policy. Has the same tax deferral. That's true for any permanent life insurance policy. However, it has high immediate cash values. So if needs change, she decides to do something different, she's not penalized because of either high surrender charges or low initial cash values. So Lisa's looking at $1,000 monthly premium to put in to start up one of these policies. And we recently started working with TIAA-CREF, and so here's what their life insurance policy would look like, their universal life insurance policy. For a female age 29, if she wants to put in $1,000 a month per year, it takes a $1.5 million death benefit, because that's a fair amount of premium for a 29-year-old. So it has a fairly, not insignificant amount of life insurance. And after 1 year, she has a cash surrender value of $11,507. Put in 12, has 11,500. Like I said, there are costs to the insurance. If anyone ever tells your clients there's no cost to it or it's free insurance, they're wrong. But this is much less than a traditional whole life policy. By age 65, she's paid in $444,000, has a cash surrender value under current interest rates or current projected rates, cash values, etc., of almost $880,000. And her death benefit has grown slightly because the IRS says at any certain age you have to have X amount of life insurance for Y cash value, so it's sort of bumped up a little bit there. But over the course of time, she's paid in money and now has quite a bit of gain in the policy. So she has the life insurance, which is good. At any point in time, even here, back at age 65, if she wants to use the money, she has $880,000. At age 65, if she passes away, her spouse, her kids, her beneficiaries get 1.8. So that's good. She's had the life insurance, and it costs something every year. But with the TIAA-CREF policy, it has a very low initial 10-year term premium. And so it builds cash value in the early years very well, so that she has flexibility in case her needs change. But she also has you. And with the TIAA-CREF policy, the cash values can be included in AUM because you're going to work with her with these cash values as you would any other asset. You're going to help her with the accumulation and during her working years. But also when she gets to be age 65, you're going to still work with her and say, here's all of your other assets. How do we start living now that we're age 65? You can take withdrawals from this policy, it's tax-free. You can take loans from this policy, it's tax-free. So 1 year, maybe there's a high income year from selling something. You take the life insurance, you take the tax-free money out of the life insurance policy. So, but you're working with her through all of the different buckets to figure out what makes sense for her. So to wrap up, 20 things your 20-year-olds need to know about insurance. What else? 20 years ago, the new $20 bill came out. How's that for a coincidence? $20 bill, exactly 20 years ago. So in case you don't remember anything, you're going to remember 20. 20-year-olds, 20 things to talk about life insurance or disability insurance with them, and LLIS 20-year anniversary. And we have a number more of our 20s coming up this year. And so if you're new to LLIS, we have our top 10 things that make us different. Maybe I should make it 20. But number one is monthly webinars like this, CFP-CEs, and we'll touch on all kinds of different things over the course of the year. This was 20-year-olds. Next month may be in Disability Awareness Month. We'll talk about disability and on through annuities, hybrid combos, lots of different things that we can help you and your clients with over the course of the year. But if you're not familiar to LLIS, we're not your competition. We do insurance. We don't manage money. We don't do any of those things. Our only clients are family advisors who we partner with to help clients with the insurance things that come up when they're in their 20s, 30s, 40s, 50s, 60s, 70s, some 80s. We do our best to save you time. We'll help review existing policies to find ways to save your clients money. We do a lot of pre-underwriting to avoid surprises if a client does apply. We have lots of tools on our website under client tools and advisor tools. We're proud sponsors of a number of different family financial planning groups, and we'll be exhibiting and coming to all of the conferences over the course of the year. We have specialists in life insurance, disability, long-term care annuities, and hybrid solutions. And we manage clients' policies now and in the future, help advisors and clients not ever miss a premium with our advanced premium email or our APE or our notice of term expiration. And in October, we launched our LLIS system. So it's an interactive way for clients or advisors to be able to find information about clients' existing applications or policies all at the click of a mouse. And so thank you all to everybody for tuning in. I've gone over just an extra 2 or 3 minutes, but I have one more question. It says, what happens to the cash value in a life insurance policy when a client dies? Does it disappear? Is there a strategy of withdrawing cash value at a certain age? So good question. With most life insurance policies, there's going to be a cash value amount and a death benefit amount. Some policies are going to be what's called option B, which might say it's a $500,000 life insurance policy plus the cash value. So if there's $500,000 policy option B with $200,000 of cash value, the death benefit's $700,000. Most policies are going to be a level death benefit or with whole life. It increases a little bit as there are dividends, but it may be a $500,000 policy with $200,000 of cash value. So if the death benefit is $500,000 and somebody dies, then there's $500,000 that goes to a beneficiary. So does it disappear? Sort of. The death benefit, when you have more cash value, you have lower cost of insurance because you're only paying for the net amount at risk. A $500,000 policy with a $200,000 cash value, I have $300,000 of insurance in that case. Is there a strategy of withdrawing cash value at a certain age? So if we take that example and I have a $500,000 death benefit, $200,000 of cash value, and I'm 80. If I take out $100,000, I get to use the $100,000. Take a withdrawal of $100,000. It's tax-free. My remaining death benefit is $400,000. So depends on who I want it to go to and when. In that scenario, I might need the money, and so I take the $100,000 and I'm still leaving my kids $400,000. That's great. But if I take a loan of $100,000 and I die, the $500,000, the insurance company pays itself back the $100,000 loan. So then my beneficiaries get $400,000. So when I take money out of the policy, it's going to reduce the death benefit. So yes, it may make sense. However, you would never want to take out so much too soon that the policy lapses without, you can actually take too much money out too quickly and then it lapses. So I hope I answered that question. If not, feel free to give me an email or give me a call and we can discuss. So I hope everybody has a great rest of your day. It's been kind of raining and thunderstorming here, so no electronic hiccups. So thank you all very much. We appreciate it. And Kathy Bilodeau will be talking to you all next month for Disability Awareness Month. Thanks, everybody.